Last week, we saw possibly one of the most shocking numbers of 2025, the latest jobs reports in the US. And it has everybody now starting to clamor for different investment assets. Where is the smart money going right now, and why should we be paying attention? In today's video, we'll break it all down together, including why the economy and the markets may be very different things. What happens over the next 3 to 6 months is going to matter, and it all comes back down to a special announcement from the Fed, most likely this month. Join us, guys, in today's special edition of the Macro Edge. We'll see you in a moment. Well, welcome back, everybody, to the Macro Edge. It's great to be here, and I hope you are having a fantastic day. In today's video, we'll break down what just happened when it comes to delinquencies and levels that we haven't seen in multiple years, where the structure of the market's going, the key technical levels that you need to be watching, and of course, what really is going on with these jobs numbers. Where is that smart money flowing? So we'll start off here with the 60-day delinquency rates, because it's clear to see that we've got a new all-time record since we began tracking this data. And that comes to subprime auto loans in the US. Basically, everybody was going out and buying a car back in 2021 and 22, and now people are unable to keep up with those repayments. Why? Well, of course, we saw inflation and interest rates have remained higher for longer. And this is having an impact across all things, including the US jobs reports. Now, it may be tariffs, it may be other things as well, but at this point, what we've been starting to see is huge revisions when it comes to the reports themselves. Bluekurtic here has a really good chart, I think, that really demonstrates what's happening here as things degrade in the US over 2025. Back in 2024, we were revising up, then we were revising pretty much to the same up until around May. And then the shocking report last month came out showing that actually the US hadn't put on anywhere near the amount of jobs that people had thought. Well, as it turns out, the latest August report actually went from 75,000 all the way down to 22. And we also lost jobs when it comes to even the revisions over the June and July quarters. Or months. So why does this matter? Well, it's all got to do with people having a tougher time to get jobs out there. And you may already be aware of this in your current industry, and potentially you're seeing it out there on the ground levels. But has the market really caught up to this? Well, sometimes it doesn't, because of course there is an expectation now that we'll get potentially 2 rate cuts in 2025 and possibly even upwards of 4 in 2026. Here's the latest data. Again, a new record when it comes to surveys showing that people may not be getting let go of or losing their jobs, but of the people that are looking for new jobs, you can clearly see it's never been harder since the beginning of this survey back in 2013. So it's kind of like becoming a huge problem. And we're also seeing issues when it comes to any other economy. Canada's also having problems here, youth unemployment in particular, driven by most likely AI and just huge amounts of people being out there that can't get jobs. You can see it is at 15%. And this turns out that it's at actually a 15-year high. So how is it then that markets are continuing to actually rally up? Well, a lot of it has to do with probably this chart here. And here is where we see the disconnection between the markets and what's actually going on right now. We have, of course, people early on in their career having a really tough time at getting a job, particularly software developers and customer service, arguably the 2 most affected areas by the new onset of AI technologies. And people in the middling of their careers usually holding on to their jobs, not really having too much problem. The thing about AI right now is, of course, it's really about, can you recognize when it makes mistakes and then, of course, augment it. So it's like somebody with some experience could potentially be doing the job of 2 people with this as a helping hand. That may change in the future, but for now, it seems like this is where the market's at. And of course, what that's doing is it's leading onto companies being able to have less staff and more productivity. And that's equaling, of course, more profit, particularly in the Mag 7 stocks. But maybe this is the chart that we all need to be watching over the next 12 to 14 months. And this is, of course, US real total construction spending. It's pretty unusual to see it down at these levels. And the last time we saw this was around 2006/2007. And it marks a bit of a kind of disconnection again from the stock market to actually what's happening when it comes to the economy. Clearly, the economy is starting to show a little bit of weakness, but it certainly isn't impacting the stocks themselves. If we have a look here at consumer discretionary, we just saw a new record inflow last week when it comes to the technology stocks, in particular these. Amazon, Tesla, and others are starting to actually get quite a lot of flows going back into them. And this means that what we call 1/3 of the US economy, or the American consumer, is about to make a new all-time high. Now, if this happens, it really tells you that we're still risk on in these markets. And I think the important thing here, especially what we like to do here on the macro edge, is we like to marry up technical analysis with, of course, the macro side so that we can see flows and how they're appearing on the markets. Now, we call this the American consumer, which makes up 1/3 of the US economy. And obviously, if this is going up, it kind of signifies risk on is currently going through. And we recently did a survey over at FX Evolution, and what we found was that most people are pretty confused about whether we're going to head into a recession really quickly or whether we're just never going to see another recession. 25% of respondents said that this bull market will never end. Maybe that's a little bit more of a joke as well. But actually, the most popular was within 6 to 12 months. So it again marks out that maybe where the real problem lies is actually the next 1 to 2 years. Be interesting to know what you guys think in the comments down below on this one, as we're always interested in everyone's opinion. And the key thing here is that it's something that I think a lot of people have very strong opinions on. Let's now have a look at where the biggest trades have been coming through. One of the big notables has been China in recent months. And we can see here that China just received on one of the 3 times levered funds quite a large dark pool transaction. This, of course, marks the potential. Of course, a dark pool is both a buy and a sell between 2 large entities done off market and then reported. This is kind of marking a point of a critical juncture point. Basically, the trend is currently up. If we see flows continue to go up, it could mark a very important buy. And that's something that we're looking for in those markets. Meanwhile, in America, we're in the toughest time of the year. The September high period, well known around the middle of September to see a sell, could be happening again. And what we've actually seen, especially in more so the tech stocks, up until the last 24 hours, we've basically been seeing a very sidewaysy market in tech stocks over the last kind of 1 to 2 months. And what this is leading into is potentially the normal pattern that we see in post-election years. And of course, a lot of traders and investors are betting on this idea that the market will improve into the end of the year, even if we see extreme volatility. Take a look here at some of the charts. You can see Whaley's chart here really showing us some key levels and particularly showing us that summer was pretty strong. At a 5% summer in the S&P actually usually equals, that is June to August, actually equals here a potential for October to be the most volatile month of this year, other than, of course, the Liberation Day month. So why is this important? Well, only 6 times in similar surveys did we actually see a bullish market, and 18 we saw down, some of them notably being the 87 crash. So let's talk about the elephant in the room. And of course, that is what is smart money doing right now? Well, it looks like they're continuing to buy gold. Central banks in particular have been purchasing gold for the last 2.5 years. If you're a fan of our work, you would know we've been talking about this for quite some time, but it just tapped into the 3650s at the time of this recording, and it's now up 46% year on year. We've also seen investors switching back into gold futures recently, just before this big pennant breakout. And I think this is really where you start to see central bank purchasing, which is now at higher rates than treasuries, first time since the 1980s and 90s. We've seen something like this happen. And of course, excellent technicals linking up together. You can see here the pennant and what it's really doing for the markets. A huge move here in the overall charts. And at the time of the pennant break, which happened around 34.50, we've now already put on well over almost $200 on gold. Could it go all the way? Well, a pennant would usually break all the way to 4,000 to 4,200 if it's to follow a similar leg path. But just remember, it usually isn't a vertical move. There's generally quite a lot of volatility along the way. And one of the first key levels that a lot of people are going to be looking at is something like this, where A equals potentially B, and we see kind of like a symmetrical triangle or type of play there. Now let's also talk about Bitcoin. Now, a lot of interest in the crypto markets in recent times. Tom Lee, obviously famous for being quite bullish and optimistic on markets, has just come out recently and said that he believes that Bitcoin by the end of the year will get to 200,000. Do you agree with this statement? Also interested to hear your comments, but it does make some sense when you think about what's been going on here with the halving cycle. We're currently in a bit of a doldrums for Bitcoin after having an epic year so far. And funnily enough, that happens in other alt periods. Remember, the alt cycles often have what they call a bear trap that can appear near the end of the halving cycle, which often ends into the end of the year, which would be December. And generally speaking, there'll be some resurgence in bullish activity. Sometimes the Bitcoin actually loses between 20 and 30% during these times. Not sure that's going to happen again. And then we see a rally. And it's kind of this path to the alt season that we often see during these times. It's a really interesting case here when it comes to, of course, where the smart money potentially has been moving. We've seen gold, but have we also seen an uptick in some other markets? Well, let's now take a look at some of the leads that are going on right now. First up, NASDAQ versus the S&P. We see, of course, an improvement here in the NASDAQ over the recent last couple of days. And this comes off probably more of a weaker jobs market. You might say, well, how is that possible? It's because it's expected that the Federal Reserve will do so many cuts. And on top of that, they might be able to hold the market just barely together. And on top of that, they may also implement that famous thing, which is, of course, QE once again, quantitative easing. Now, if they do that, of course, it's going to send a little bit of a rocket ship underneath the markets because they've long expected that the Federal Reserve will eventually come back and support it. What is not being taken into consideration, though, is, of course, what's going to go on with inflation. So there are a couple of charts that are worth watching. On the macro side, you're also going to be wanting to watch semiconductors. Been going sideways for quite some time, but obviously if it breaks up or through, that's going to be a huge breakout, and that's going to be a key one. Remember, this is currently what we call a pit or a pullback in time, so that'll be something to worth watch. And of course, then we've also got the US dollar, which comes under some significant pressure this week into both the CPI and the PPI data. Now, this is the inflation reports coming through, and you can see here that the dollar is currently putting a big amount of pressure on the downside as the expectation of more rate cuts coming through and possibly even what they call dollar debasement is occurring. And what this is pushing into is obviously some of our kind of favorites recently, which have been to do with these yields, which is things like gold, which is going ballistic at this stage, getting closer to that 37.50 on the charts, and silver, which is now making new highs, just tapping into that 41 plus and potentially getting up to the 42, 43, which it hasn't done for, a very, very long time. In fact, if you actually zoom this out, you'll see the last time we were at these levels was actually 2011. So a lost decade for silver, starting to improve here in the markets. Some other notable charts that I think are worth watching: oil, as it kind of starts to find its, potential accumulation base. At Lovin, Hood, all of these stocks that have now been included in the S&P 500. And then we also have, of course, the elephant in the room right now, which is Bitcoin. And the key level here for Bitcoin is going to be around that 113,500. Why? Well, it's down to a couple of charts. The big thing here is, of course, the shooting star rejection, the high level, and where we've been basically seeing markets get back up to. And you can see here we've got a series of currently lower lows and lower highs. So there's a lot at stake for this particular crypto, and we will be paying close attention to that 113,500 should it break and close above. And at the moment, if the bears can keep pushing it down, some key levels are around 104K, one of the most traded zones on the way up, and that 98,000, which would mark around 21% down for Bitcoin and kind of be in line with some of the other halving cycles. But what do you guys think? Which one are you looking at in particular right now? Where are the best opportunities? And where are you a little bit worried about these inflation figures? PPI coming out before the overall CPI this week, and that's going to be at 8:30 New York time. And then, of course, we have CPI coming here as per Forex Factory's calendar, which will come out at around 8:30 a.m. on Thursday. These are sure to be volatile events, guys. So as you know, the main thing here in markets is to keep an open mind, keep an abundance style mindset whenever you're looking at things, and to realize there's always another opportunity. Plenty of market moves. The S&P 500 is slowly grinding up, and it looks like we've seen a decent kind of sideways here for the last couple of weeks and months. But will it be Wayne Whaley's data that comes true? Well, only time will tell. Thank you so much for watching. Give it a like if you enjoy. We'll see you in 2 weeks' time. Bye for now.